Hello, and welcome to the next video in my series on operations management. Now, just a reminder that these videos are geared towards individuals that are new to operations management. So if you are working on your MBA somewhere, these videos are probably a bit below what you would need. However, if you just want to get the basic idea of operations management, then these videos are for you. Now, in this video, we will continue our discussion of time series forecasting. And more specifically, we'll be talking about moving averages, which is another way of forecasting data into the future. So as always, we're going to start out with a problem. Now, let's say you work in the Office of Institutional Research for a large Midwestern university in the United States. The administration has tasked your office with producing enrollment forecasts for next year based on historical enrollment data. So of course this helps the university determine what kind of resources it will need, how many students they can expect, and so forth. So what are some of the forecast approaches you could use to offer your best estimation of next year's enrollment? So in this video we're going to talk about three possibilities. The first method is called the naive approach. And all that means is that we're going to use last year's data and say, well, that's what next year's data is going to be. As you can see, it's very simple. And I use the phrase second verse, same as the first, because we're just repeating last year's data. The second approach is the simple moving average. And I call this straightening out the curves, because we're going to average together a certain amount of past data in order to forecast the unknown data in the future. And the third is called the weighted moving average. And the phrase I give this one is, what have you done for me lately? Weighted moving average emphasizes data that is closer to the present. So instead of averaging the 3 years before now equally, we might emphasize last year's data more than the year before that, and then emphasize that data more than the year before that. So here is the enrollment data we're going to work with. And this is actual enrollment data for IUPUI, which is Indiana University, Purdue University in Indianapolis. And this is IUPUI's enrollment from 2002 up through 2011. And as you can see, it starts around 29,000 students and increases to about 30,500 by 2011. So that's a 1,500 student increase. Now we're going to work with moving averages to see how close, if we were to go back in time and figure out moving averages for successive years, how close would that be to what the actual enrollment was? So here is the enrollment graph. And as you can see, in 2002, IUPUI started at around 29,000 students. There was a quick jump up in 2003, sort of a plateau through 2005, a small dip in 2006 and 2007, and then an increase again 2008 through 2010, 2011. I always encourage you to work with graphs because the way we understand things, especially in a visual culture, is through looking at it. So always make graphs of your data because they can tell you a lot more than just looking at a column of numbers. So let's talk about the naive approach. Now, simply put, we just assume the enrollment for the next period, in this case next year, will be the same as the enrollment from the previous year. So the 2011 enrollment was 30,530 students. So using the naive approach, we would say that the forecasted enrollment for 2012 is also 30,530 students. Now, of course, this is the easiest and most simplistic method you could probably use. But for some data, especially stable, non-trending data, the naive approach is actually the most cost-efficient and time-efficient forecast method. So really it just depends on the characteristics of your data whether or not the naive approach is applicable or not. So now let's talk about the simple moving average. What we do is we use a certain number of consecutive historical data points to calculate a forecasted data point. In this case, we're going to try to forecast the 2012 enrollment. The simple moving average is best used when the data points are relatively stable over time. So in this case, if the enrollment was jumping around 5,000 students each year, then the simple moving average would have some problems, and many forecasting methods would have problems determining or predicting what next year's enrollment would be. It could produce one, but our confidence in that would be kind of shaky because there's so much variability in the data, in this case enrollment. The simple moving average smooths out bumps in the data. So if there are bumps and hills and small variations in the data, the simple moving average will smooth that out evenly. Now the formula for the simple moving average, and don't freak out, this is not difficult math, goes like this. Now that sign at the beginning of our fraction is sigma, and all that means is the sum of. So I'd like you to get used to using Greek symbols because they come up a lot in other things. So just get used to using them and they'll become second nature. But sigma just means the sum of. So on the top of our fraction we have the sum of the enrollments in previous n periods. And all the n means is the number of years or periods we want to average together. So if we wanted to do 3 years, which we're going to do in this example, that just means, okay, add together the enrollment for the previous 3 years. That's all the top of that fraction means. And then in the denominator in the bottom, n is just the number of years we're doing it, in this case 3. So all this fraction here is saying, in the case of 3 years, is saying, okay, take the enrollment for the previous 3 years, add them together, and divide by 3. And that will give you your simple moving average for right now. That's all that formula means. So let's go ahead and look at this in practice. So the first 2 columns are things we've already seen. We have our year and our enrollments. Now over on the right-hand side, we actually have the calculations for our 3-year simple moving averages. Now notice in the lower right, we have 3 blacked out cells in our table. Well, those are that way because to figure a 3-year moving average, we have to have 3 years of prior data. And for 2002, 2003, and 2004, we do not yet have 3 years of data to do our calculations, so we have to leave those blank. However, in 2005, we can go ahead and do our calculation because we do have 3 years before it. So for example, in 2005, to figure out our 3-year simple moving average, if you look over on the right-hand side, we're going to take 2002 plus 2003 plus 2004, the enrollment for each one of those years, and divide by 3. Now if we go up 1 row, to find the 3-year simple moving average for 2006, we're going to add together the enrollments for 2003, 2004, and 2005, and divide that by 3. Now you can begin to see why this is called a simple moving average. As we go up our table, we are dropping the first year and then adding a year at the end. So once we go from 2005 to 2006, we are dropping 2002 from our calculations and we're adding in 2005. We go up. We're dropping 2003 from our calculations and then adding in 2006, and so on and so forth. And that's why it's called a moving average. So now that we know how to calculate each one, what exactly is the data? So when we do that arithmetic, over on the right-hand side, you can see that for 2005, our 3-year simple moving average is 29,613. Now we know that the actual enrollment was 29,933. So you can see that we're within about 300 students of what we expected based on the enrollments from 2002, 2003, and 2004. So if it was the summer of 2005 and we wanted to make some sort of prediction about the enrollment in the fall using a 3-year simple moving average, we would have done exactly what's in this table. We would have guessed, or figured out, not guessed, figured out, 29,613 students. Our actual enrollment was 29,933, so we were just a bit off, but pretty close. Now if we graph our 3-year simple moving average on top of our enrollment, you can see how they're related. So let's look at the beginning of the 3-year simple moving average. You notice that it starts below the actual enrollment for 2005. Well, why is that? That's because we had a very low year in 2002. And when we added 2002, 2003, and 2004 together, it dragged down our simple moving average to a bit below what the actual enrollment was. Now, if you notice, in the actual enrollment in the orange, we had a dip from 2006 and 2007. Now look at our blue line. Where is our dip in the blue line? Well, it's out ahead of that. It's in 2008. So the 3-year simple moving average did not pick up the dip in the actual enrollment until almost 1 to 2 years later. And that is one of the drawbacks of the simple moving average, or moving averages in general, is that they tend to lag behind, they lag the actual enrollment data. However, if we continue past the dip in the 3-year moving average, 3-year simple moving average, you can see that it picks right up along with the enrollment and flattens out nice and even. Now look how smooth the 3-year simple moving average curve is compared to the actual enrollment. When I said that the simple moving average smooths out the data, this is exactly what I mean. It's a nice smooth curve, whereas the enrollment data is choppy up and down, has little bumps and dips and things like that in it. Now what is this mess? Well, I just wanted to give you another example besides college enrollment data. Now this is the stock chart for Apple from the end of last November, actually, up through yesterday, which was July 3rd. Now the little candlestick marks, that's what they're called, along the stock price, those aren't really of concern to us that much. What I'd like to move your attention to is in the upper left. You will see 3 different colors along with 3 different labels. We have MA 50, MA 200, and MA 14. Now you can probably imagine that MA stands for moving average. So each color line in the stock chart represents a moving average for a certain number of N days. And in this case, we have 50 days, 200 days, and 14 days. So let's look at the 14-day moving average first, and that's the green line. Well, notice that one, it's a bit more choppy, because it's only using the previous 14 days stock price to calculate a data point. So the 14-day moving average tomorrow will average together the previous 14 trading days for Apple. Also note that it follows the actual stock price pretty closely, and that should make sense because we're using a very short time period of 14 days to calculate that moving average. So it's going to follow the stock price pretty close. Now look at the blue line. That's the 50-day moving average. And again, it follows the stock price pretty well, but notice that it lags the actual stock price. So the moving average is below the actual stock price because it's taking into account the cheaper or lower stock price in the previous 50 days. So it's lagging quite a bit. But also notice it's a lot more smooth than the green line, which is the 14-day moving average. Now look at the 200-day moving average. That is a lot of days we're averaging together to get our data point. So the stock price tomorrow, the 200-day moving average will be the average of the previous 200 trading days. And as you can see, that it's very, very smooth and flat. And that's because we're averaging together so many days. Now there's an entire branch of investing called technical analysis that loves this kind of thing. They look at moving averages, they look at moving average crossovers, which I'll point out 1 or 2 here in a minute, and they follow not really the fundamental economic indicators of the company, they follow the trends and patterns in stock pricing. So if you look at the blue and green lines, you'll notice that they cross a couple places. Down in the lower left, our 14-day moving average crosses above our 50-day moving average. And that's when the stock really started to take off. So when the stock took off back in December of last year and in January, the 14-day moving average really ticked up because it was using those new prices to calculate itself over time. So the 14-day moving average really went above the 50-day. Now if you look over on the right-hand side, around mid-April, the Apple stock had a correction because it really shot up. over the previous 4 months. So it had sort of a correction. And what happened with our moving averages? Well, the 14-day moving average, because it's more sensitive to recent price data, really took a dive downward to the point where in the beginning of May it actually crossed below the 50-day moving average. Because remember, the 50-day moving average is not as sensitive to recent price movements because it's taking into account many, many more days. And the 200-day moving average didn't really move at all. It flattened out a tad. It flattened out a very little bit right around May. But you really can't see it, as prominently as you can in the other moving averages. So then we progressed through, and then the Apple stock price kind of picked back up again. And then here recently, right towards the end of June, the 14-day moving average went back above the 50. And those 3 white boxes there on the end are 3 days when the Apple stock really shot up. So it shot up from about 580 or so up to 600 in those 3 days. So then the 14-day moving average, sprung up because it took into account those previous days. So this is just another example, a very prominent example in the investment community on how moving averages are used to flatten out and see trends long-term in data, and in this case, Apple stock. So let's talk about another method, and then we'll be done. The weighted moving average. So here's an example. And as I'm sure you know or remember, many teachers, including me, apply weights to certain assignments. So tests and exams, or maybe even attendance, may be worth more than homework in calculating your final grades. So if you're in college, you may have been mortified when you go into a class and the instructor says, your midterm is worth 50% and your final exam is worth the other 50%. Well, you better be a good test taker, right? So instructors and teachers all the time weigh different types of assignments differently. The weighting moving average works the exact same way. What we were able to do is emphasize more recent data points. So in our enrollment example, we could make year 2 twice the weight of year 1. And we could make year 3 twice the weight of year 2. And that would emphasize year 3 over year 2, and year 2 would be emphasized over year 1. So what exactly would that look like? So on the left-hand side, you can see our periods. And this is basically, you can think of it as year 3 is the most current to now, year 2 is 2 years ago, and year 1 is 3 years ago. So year 1, which is 3 years ago, we're not going to give it that much weight. We'll give it a weight of 1. And then the next year, we're going to give that a weight of 2, which is twice year 1, 1 times 2. And then year 3, which was basically last year, we're going to give that a weight of 4, which is twice the weight of year 2. So we're emphasizing year 3 much more than year 2, and year 2 much more than year 1. And definitely year 3 more than year 1, 4 times the weight. So in formula notation, all this means that we're going to take the weight for each period, multiply the enrollment for that period, and then we're going to sum all that together. Very simple. And then we'll divide by the sum of the weights. And in this case, that's 7. So if you look at the bottom there, you will see we have year 1 times 1, plus year 2 enrollment times 2, plus year 3's enrollment times 4. And then we're going to divide by the sum of our weights, which is 1 plus 2 plus 4, which is 7. So how will we go about figuring out the 2005 weighted moving average for enrollment? Well, for 2005, we're going to have 3 years in the past we're using. So year 1 will be 2002, year 2 will be 2003, year 3 will be 2004. And we're going to give each one a weight. So 1, 2, and 4. So here we are. I put the 2002 and 2003 and 4 in quotes, so you know that's the year. That's not the enrollment. So we'll go ahead and go to our chart, and I'm not going to go back to the chart, but let's go ahead and substitute the data in. So the enrollment for 2002 was 29,025. The enrollment for 2003 was 29,860. And the enrollment for 2004 was 29,953. And we're going to multiply each one by its respective weight. So you can see just by looking at this little formula that the enrollment for 2004, which is the closest year to 2005, is going to get the highest weight. It's going to get the highest importance. So when we do out that multiplication, you can see that we have 29,025 plus 59,720 plus 119,812. So at this point, you got to stop thinking about them really as enrollments, because the multiplication is just a weighting factor. Now, of course, the sum of our weights was 7, 1 plus 2 plus 4. So we'll divide that by 7. And we come out with a weighted moving average in 2005 of 29,928. And that should make sense. If you get some crazy number like 78,000, then you know you've done something wrong somewhere. They should all be around 30,000 or so. So the weighted moving average for 2005 is 29,928. Now I went ahead and calculated the 3-year weighted moving averages for all the years from 2005 to 2011, and you can see that it closely follows the simple moving average and the enrollment. So if we look at, let's look at 2007. We have an actual enrollment of 29,854. Our simple moving average prediction was 29,883. Okay, that's less than 30 students away from the actual enrollment. And then our 3-year weighted moving average was 29,840. So that was 14 students away from our actual enrollment. So you can see we can actually determine which method works best with our enrollment data. And each type of data will have a best in, or a best number of periods to use when figuring out the moving averages. You just kind of have to test them out. I mean, there is a statistical way to find out the best in, but we're not going to go into that here. We're using 3 years on both the simple moving average and the weighted moving average. So here is the graph of all three. So we have discussed the enrollment graph, which is the orange color. We have discussed the 3-year simple moving average, which is the blue. And now we have the 3-year weighted moving average, which is the yellow. Now look at the beginning point for the 3-year weighted moving average. Well, it's almost exactly, where the actual data point was for 2005. Now why is that way, while the 3-year simple moving average in blue is way down below it? Well, remember that the weighted moving average emphasizes data that's closest to that point. So the yellow point of our first weighted moving average takes into account 2004 and 2003 much more than the blue starting point does. And there you can see the effect of weighting. We've really emphasized 03 and 04 for the weighted in the yellow, but for the 3-year simple moving average, 2002, 2003, and 2004 were all given the same weight. So if we look at the flow of our 3-year weighted moving average, we can see that it's even smoother than the simple moving average and much smoother than the actual enrollment data. Now notice that the 3-year weighted moving average follows in the enrollment much more closely. It's much closer to the orange than the blue is. And that should make sense because we're using the prior year's data in a weighted fashion that emphasizes the previous year and the year before that much more than 3 years before. So it's going to follow much closer along, just like the 14-day simple moving average did in Apple. So there you can see the visible difference between all three. Now, interestingly enough, look at the last data point on our graph. All three of them are almost completely together, almost spot on, probably within a little bit over 100 students or so. By utilizing prior year's data, in the end, once all the fluctuations were ironed out, they converged pretty closely here in 2011. Now I'm going to go back to our Apple and show you a specific kind of weighted moving average, which is the exponential moving average, which we'll talk about in our next video. But the blue line here is a simple 50-day moving average for Apple. It's the same one we had on our previous slide. And the red line is an exponential moving average, which is a specific type of weighted moving average. And as you can see, they follow along very, very closely. So around the beginning of 2012, the weighted moving average goes a bit above. And again, that's because it's emphasizing more recent data than the simple moving average is in the 50-day. Then, of course, when the stock takes a dive in late April, the weighted moving average, because it emphasizes data that's more recent, dips below the simple 50-day because it really takes into account those really bad days in mid-April. And then again, it goes below the 50-day moving average because of that weighting in the near term. And then at the end, here near the end of June, it looks like the weighted moving average starts to tick up above the 50-day simple moving average. And some investors that are in the technical analysis look at these crossovers and conclude that it's a good time to buy. So if that moving average that emphasizes the weighted moving average that emphasizes more recent data ticks above the simple, then that means the stock is doing better more recently, and they might take that as a signal to buy this stock. Now, we're not going to go into all that here, but I just want to show you another application of simple moving average there in the blue, and then a specific type of weighted moving average there in the red. Now, there are pros and cons to using moving averages, and it's really important to keep those in mind when you're working with your own data. Of course, a good thing is that the moving average can smooth out random blips in the data. So if you have one off year that's above or below the usual trend, it can kind of iron that out because we're doing some averaging. It's useful for trending data with an ideal N. So the N in this case, we'll talk about that in a minute, depending on how your data is trending, if you pick the right N, it can help you see that trend. Because some trends are really hard to see. Unless you do some moving average calculations, a very small trend can be hard to see until you do that averaging. It's flexible, since the period weightings are somewhat arbitrary, as is the choice of N. So in our example, we used an N of 3 years. We could have used 4. We could have used 2. But we went ahead and chose 3 because that's sort of a good balance between over-smoothing, which we'll talk about here in a minute, and getting really close to the naive approach, which would be an N of 1. So the naive approach that we talked about before is really an N of 1. Now, as far as the weightings go, we picked 1, 2, and then 4. But we could have picked 1, 2, and 3. We could have picked 1, 4, and 8, and that really would have emphasized the more recent data. So it's more flexible. We can try out different weightings and see which combination of weights follows our historical data more. Now for the cons. If we pick too large of an N, which is the number of time periods or years we're going to average, we can end up over-smoothing the data. If you remember our Apple graph, the 200-day moving average was almost flat as a pancake. It had a slight trend upward, but it was very, very flat. That's because it has a very, very large N. So when we drop off the first day, in that case, and we add the next day, we're not really changing a whole lot because we have 200 days in that moving average. So if we pick too large an N, we can end up flattening out our data like a pancake. So we have to be very careful about picking the right N. Now, if we pick too small an N, we come close to the naive approach, and then our data won't be smoothed out in a way that allows us to work with it effectively. So again, picking too short of an N can make the moving average overly sensitive. So if you remember, again, on our Apple graph, the 14-day moving average was very sensitive to recent stock prices. It was much more jagged. It followed the stock price closer, but it was not as smooth. So it was very sensitive to recent price swings. And moving averages lag the actual values. So if you remember on our enrollment data, the moving averages were often below what the actual enrollment was. And again, that's because the enrollment was increasing. So our moving average was lagging behind it because it was using older data with lower enrollment figures. The same thing on the Apple stock price. Those moving averages were almost all below the actual stock price because Apple was increasing in price so quickly that it takes the moving average time to catch up to it. So there is a lag in the moving average as compared to the actual values. And of course, the moving average in this case requires a fair amount of accurate historical data. If you do not have prior year or prior days or whatever period you're using, if you do not have accurate data and enough data, then you really cannot do the moving averages in this case. So, what is our solution? That's what we've been trying to do. Remember, we were tasked with figuring out what is our estimated enrollment for the fall of 2012, here in a couple months. Well, if we use the naive approach, that's easy. We're going to use the same enrollment as last year, which was 30,530 students. If we use the simple moving average, we're just going to average together the 3 previous years. So we're going to take 2009, 2010, and 2011, add them together, divide by 3, and we get a simple 3-year moving average of 30,493. Now if we use the weighted moving average, again we're going to emphasize 2011 more than 2010 and 2010 more than 2009. So by applying our weights in our numerator and our fraction, and then dividing by the sum of our weights, which was 7, we come up with a weighted moving average for 2012 of 30,519. Now let's look at the difference between each approach. Very, very small differences. The naive approach says 30,530. The simple moving average predicts 30,493. Well, that's only a 37 student difference. 37 students out of over 30,000. Now the weighted moving average predicts 30,519. That's actually in between those two. So if we put them in order, the simple moving average predicted 30,493, the weighted moving average predicted 30,519, and the naive approach predicted 30,530. So if we sort of use all 3 in concert with each other, we can kind of come up with a reasonable range of what we might expect based on historical data of what our fall 2012 enrollment's going to be. So we could probably put together a good estimate of between 30,500 students and 30,550 students. Now, of course, since this has not happened yet, and we won't have the data for a while for fall for the 2012 year, until then, we really can't go and see how accurate these averages are. But one thing we do know is that they're all 3 pretty darn close, which is exactly what we saw in our graph before. All right, so that is a lot of information about moving averages, but I hope you have a really firm foundational understanding of what moving averages are, because they come into play so often in business and finance and education and so forth. They really help us make an educated, not guess, but an educated assessment or prediction about what the future is going to be based on historical data. Again, thank you very much for watching, and I look forward to seeing you next time.